We're live. Hi, Aaron. Welcome to Venture with Grace.
Hey, Grace. Excited to be here.
Okay, to start the show, I would love for the audience to get to know you a little bit more. So you started your career at Catalyst Partners, and then you spent over 13 years at NEA. What was that like? So, like, what are some core lessons that you've learned early on in your career that kind of like shape you into who you are today?
Yeah, my earliest learning in my career is that venture, technology, Silicon Valley, it's all about the people. My background was in engineering. I was a huge nerd. I mean, I played a bunch of computer games, taught myself how to build those computer games, taught myself how to build computers. And so I came to Silicon Valley thinking like, oh, it's Silicon Valley. It's all about the technology. The best technology always wins. And I quickly learned that what makes Silicon Valley great is the people. I learned that at Catalyst, working for Frank Quattrone, who was one of the legendary bankers in the space, he had an amazing network. It was actually through that network and that mentorship that I actually met NEA. And the reason I stayed at NEA so long is I think NEA has the best people in terms of my partners. I'm lucky to work with them every day. And I'm also arguably, I think I'm even more likely to actually work with all the founders that we back. And so for me, at the end of the day, life is too short. I want to work with the best people who inspire me, people who I integrity, people who I can trust, people who I learn things from. And so for me, what's kept me at NEA so long is every day I can interact with a new founder, interact with an existing founder, learn something from them, get to support one of my existing partners, get support from them on a new investment. And so that's what really has kept me at the firm for so long.
I wonder, like, so you mentioned about like your mentor from Catalyst Partners, but like, who do you consider as on your personal board of advisors? Since I feel like you interact with a lot of people that are super cool. Like, I guess like I was binging through the A podcast, and then there's like the heavy hitter thing. So like, I think you mentioned about like the venture partner at NEA, it's like the former CEO of GE, some OG people, and like, who are like, I guess like, who do you consider as like on your personal board of advisors when it comes to like career development?
Yeah, so I really like, anytime I need advice, I like getting perspectives that complement my own background. So obviously the biggest compliment to me is my partner, my wife. She's very different than me. And so anything that regards, career decision, life decision, even just talking through interesting new investments. She's actually a former founder. So I always find her perspective from having been an operator, having built and exited a company to be very impactful and valuable. I also like getting the opinion of one of my closest friends from college. He's actually a politician now over in Greece. Also very different background. He was an entrepreneur himself, though he built a shipping business and exited and went into Greek politics. He also provides a really amazing different perspective. And then within my firm, I'm fortunate to have a whole bunch of folks and confidants who I'm lucky to call partners. Anything in the industrial robotics space, I love going to Jeff Amell, given his background from GE. Any company where I think go-to-market is going to be critical, and I really need help assessing, the stage, the maturity of go-to-market, especially from an enterprise sales perspective. I'm fortunate to work with my partner Hillary Kaplow McAdams. She was the former president of New Relic, head of global sales at Salesforce. She's just fantastic. And so just a ton of different partners within NEA where new investment need help with the current portfolio company. I'm able to go to them and get advice on areas that I don't necessarily have a background in.
Before we dive into your amazing investment track record, one last question on the personal side. Like, what's one skill that you're constantly trying to get better
at? It's honestly, this is going to sound cliche, but it's definitely focus. One of the other learnings besides people is I think it's really important to be incredibly generous and kind and nice in your career. When you're working with people, you really want to invest in relationships for the long run. I mean, I'm leading an investment right now of a founder, which I've known for 3 years, actually. He was actually an early employee in an NEA company that we funded a decade ago. And so for me, it's all about being generous and kind. And, when people ask for help, to help them, or also to volunteer your own time and resources. But the flip side of that is in Silicon Valley, everyone's looking for help. Everyone wants to, ask you, how can I get to the next, step, milestone. And so the flip side of being generous is that also ends up taking up a lot of my time. And so I need to get better and better about focusing in terms of, I would love to be able to help everybody, but I often find myself running out of time because I'm just chasing too much, whether it's new investments or, so also making time for current portfolio companies. And then also everything outside of career, like family, which is obviously the most important thing.
For sure. Okay, so you have invested in some iconic companies like Databricks or Together AI. Why don't we pick any one of your portfolio company that maybe if you could walk us through how you're thinking about it, how you meet the founder, and then like your diligence process to, like I guess like the trends in the industry that you're seeing that like, and then how you're like picking that company through maybe examining like a bunch of different other companies and then how you're thinking about exiting.
Yeah, well, I think pattern matching, it's kind of generalization. I think to overgeneralize is often why you actually pass on a lot of really amazing investments. So I try to pattern match to some extent, but I also like to think from first principles. Why is this team, why is this founder, why is this company more likely to succeed? And so that kind of comes back to, maybe an example would be Databricks. So the first question is always the founder, the founding team. And when I'm looking at investment, I always like to ask myself, why this founder, why this team, why are they more likely to succeed than anybody else? Why are they best suited to build this company? Sometimes it's because they have expertise and they're industry insiders. Sometimes it's because they aren't industry insiders. They see something different that everyone's been overlooking. In Databricks, the case was they actually were insiders and that this was a team of researchers out of Cal. And they were all founders of this project Spark. And that was super interesting to us because we had a thesis at the time, which kind of gets into after you look at a team, the other thing I like to look at is market and technology, and they're very much interrelated. But the thesis at the time was that Hadoop, which was a widely used big data processing software that was heavily deployed on-prem, and it was very complicated to use. It required you to rack and stack your own storage and servers. And the Databricks vision was, let's take this thing called Spark, which is much easier to use, much more performant than Hadoop. Let's put it in the cloud and just give it away, and we'll see, what happens. And the idea that you could just basically use Spark through them and get up and running and do all your big data processing. That was really interesting for us. We thought the market was obviously big because Hadoop was already a pretty large market. You already had Cloudera and a couple other fairly large, billion-dollar public companies. And the demand for data was growing exponentially. So the market was very huge. So the market checked the box. And then the kind of back to the team, we really believe that Spark was going to be the thing to disrupt Hadoop, and who better to go build the world's best, most amazing Spark company than all the founders of Spark. And even though they didn't necessarily have operating backgrounds outside of the original CEO, who's actually a previous CTO of one of our current portfolio companies, Conviva, which is actually how we actually got to know Databricks. The team didn't have a really deep operating background. But what we believed is like by being the founders of Spark, by really being focused on open source, being focused on the community, and also going at it with a more cloud approach, so giving basically a product away for free, it would just really remove a lot of the existing friction that existed in the world of big data processing. And so the thesis was that if you build it and you give it away for free and you have the best open source project, the best technology out there, you're going to get a lot of the growth, like a lot of the traction, a lot of the customers are going to come to you. Which gets into the fourth point, which is really all about distribution and go-to-market. And we thought that the product strategy of going cloud really complemented this go-to-market. And so kind of coming back full circle, the team and everything's interrelated here. The reason we got comfortable with the team is, look, for this type of product, if you do a cloud-based product and you make it free or freemium, you're likely to get a ton of amazing customers if it works. And we can help work with the team to grow them over time. We got super lucky with the Databricks team, which is that even though the team didn't have a ton of operating background, we got very fortunate that Ali, who actually took over as CEO, turned out to just be, an incredible beast of a CEO. Definitely one of the best CEOs I've ever worked with. And so we were fortunate that we backed a team which, just was of athletes, right? It wasn't necessarily about the operating background. It was a team just had a really steep slope of the curve. And that's another thing that we look for in the team. It's not only is why are they the best suited team person, partners to do this out of anyone else, but can they grow? Is the slope of the curve so steep that they're just going to move faster, innovate faster, have an incredibly fast cycle time, learn faster, refuse to give up, figure out all the different types of problems. If they see a brick wall, like, how do you go around it, above it, through it? Those are the really types of teams that I like to back. And so for me, it's always teams, number one. Market's got to be big enough to create a generational company, and then it starts to go more towards the technology product and ultimately the distribution mechanism.
I wonder, so like how you're thinking about like, I guess like can you give us an example of like how you're thinking about how much to put into a company and how that like I guess like involved with like the portfolio construction? And then like maybe we could start with like I feel like NEA is like such a unique place where you guys raise seed checks to like Series C and above. And like, you know, I guess like maybe for the audience who may not be familiar, maybe we start with like this like NEA investment strategy to, you know, how you're thinking about how much you would put into a company, how much ownership that would like actually make sense for you to like return the whole fund, or like thinking about the, I guess like the exit strategy kind of thing.
Yeah, so we, our strategy is it's actually multi-stage, multi-sector, multi-geography.
Mm-hmm.
And so the way we think about investing is out of two funds. So we have an early stage fund and a growth stage fund. And both of those are investing across multiple sectors. So healthcare, consumer technology, enterprise technology, both those are very broad, right? The enterprise is everything from SaaS applications to infrastructure software, to chips, to robotics, frontier technology. Healthcare, very similar, biotech, medical devices, healthcare services. So it's very broad across both those funds. But in terms of the sizing and the stages, it's different. And so the early stage is primarily focused on Series C through Series B investing. The growth fund is pretty much everything beyond that. We typically invest around 20 million ARR revenue, striking distance of that. And the growth fund is typically much larger checks, much fewer investments. It's much higher conviction, higher confidence bets. In the early stage fund, we like to do primarily Series A's with some seed and some Series B investing. And the way we like to think about sizing risk is typically the Series A, we want to invest when there's some sign of product market fit. We occasionally will invest early if it's a team that we have high confidence in that they'll be able to execute. That gives us more comfort of maybe giving them a larger check up front before product market fit. But typically our Series A investments, it's usually 10 to 15, 10 to 20 million dollars is typically the Series A. And we're typically looking for, ownership in the 20 to 30% range, somewhere in there. It really depends on the deal, on the risk, the founders, the capital intensity. So there's a whole bunch of things that we think about. But usually, north of 20% is what we like to get. And the reason is because the limitation we have at NEA, it's not money, it's time. We can only be a part of so many companies. And for the outliers, I mean, we have a $3.1 billion early stage fund and $3.1 billion late stage fund. And so you need to own a meaningful enough chunk because so few of our companies are actually successful to the level that we need them to be. Just the nature of venture capital, it's a very slanted industry. The goal is to find the outliers of outliers and to look for the 10, 20, $40 billion type companies. It's like the Databricks is what we're going for. We're fortunate to have been in many multi-billion, decacorn companies. That's what we're looking for. And if you can get 20% ownership, you'll get diluted over time just by options pool, just by follow-ons. The idea is you want to own, 10% plus of one of these 10 billion, multi-billion dollar type companies. And that returns the fund, arguably even returns more than the fund. And that's just one company. If we have, 80 to 100 companies in an early stage fund, ideally we have multiple ones of those. And for many of our funds, we've been fortunate to have multiple decacorn type companies. When you get back to that type ownership, that's really what ends up moving the needle and generating an amazing multiple for all of our LPs. And the growth stage fund, much higher checks. So the growth stage fund is typically $50 to $200 million type investments. We have a lot fewer companies in that fund, but higher conviction that they're more likely to be successful. It goes both ways. The early stage fund, we're taking a lot of risk. The early stage fund should be taking a ton of risk, right? Series A, it's pre-product, it's product market fit, but there's still a lot of risk and there might be more product work to do, go to market risk. Growth, we try to remove a lot of those risks. It's just like keep doing what you're doing, throw fuel on the fire. But the difference is the multiples of the growth fund are going to be a lot lower. So we're not just going to have 100x, 1,000x in our growth fund, but the goal is to have more consistency, but also to not, basically not lose money out of the growth fund because we have much higher confidence in the companies that we're backing.
Wow, love that. Are you okay? I hope you're okay. Please do not.
Yeah, I am. My house was under construction this weekend, and we just moved back in.
No.
We had a cleaner come, and I think 90% of the dust has been removed, but I still feel like I'm picking up a little bit of it. So you may hear me drop slightly.
Okay. I hope you feel better. Okay, so I wonder. So, like, I feel like as like I briefly mentioned, I feel like you're such an OG in the climate tech / clean tech space. Okay, so first of all, I want to understand like what's the main difference. Maybe we start with the climate / like deep tech era before we dive into, I guess, AI, cybersecurity, and DevTools. I think like one thing I thought were like really interesting about your experience was um, like I guess like you started looking at the space like literally 10 years ago, or like I guess like very long time ago. And how do you think about the environment or like the thought processes change through the last like clean tech era, which is like, KPCB, I guess like led the clean tech um innovation era, but like it was not really going anywhere. But like nowadays, like, since last year, everybody started investing in climate again. There's like 400 deep tech funds started last year. Like, what's the I guess like major differences that you've seen the industry change? And how do you think about investing these days? Because of I feel like the valuation is like a lot higher than I guess like previously. Nobody even like look at this sector. How do you think about the entire industry? And then what are things that you personally feel like are worth investing these days?
Yeah, so I mean, the reason I got into venture was to have the privilege of backing founders that want to change the world for the better. And clean tech was a key part of that. In the late 2000s, I actually saw Ted Schlein come from Kleiner and pitch the Green Growth Fund. And how Kleiner was going to revolutionize the world and make the world a cleaner and better place through investing in clean tech. And that really inspired me. So I came to Silicon Valley because I wanted to get involved in clean tech at some point. I started on the technology side doing investment banking, but had the fortune of moving over to NEA. And initially in NEA, I was splitting my time between clean tech as well as enterprise technology. And what I learned quickly in the world of clean tech, I actually joined kind of the peak of the first clean tech cycle, was that VCs made this mistake of investing in companies that were incredibly capitally intensive. And the thought at the time was that clean tech would scale like software or even silicon semiconductors, and that there was going to be amazing scaling laws. But that just didn't prove to be true with majority of the first clean tech investments. And so whether it was biofuels, whether it was solar, a lot of it, just the underlying economics were just super challenging. Not only that, but in certain industries, whether it was solar or biofuels, you were just competing against entire trillion-dollar industries, entire economies. In solar, the U.S. startups was competing with the entire Chinese solar industry. Anything related to biofuels, you were competing with the trillion-dollar oil and gas industry. And so the underlying economics were just very different. What really taught me is that venture capital, it isn't the right tool for all types of innovation. But things that are super capitally intensive require a lot of dollars upfront, as well as require a very long time horizon. I don't think venture is great for that. And so unfortunately, I see a lot of mistakes, the similar mistakes being made yet again in the world of deep tech, frontier tech. I see a lot of capitally intensive companies raising pretty large rounds, but it's going to be a very long time until they actually have proof that their technology is working, and also the amount of dollars that they're going to need to get a product into market and actually grow a profitable business is going to be, we're not talking about billions, we're talking about tens of billions. Now, in certain cases, that's been unlocked by areas which actually have scaling laws. The reason OpenAI and a lot of the foundation model companies have been able to raise these gobs of money is because at the end of the day, it's true software. It's software and or hardware like NVIDIA. It still coheres with all the scaling laws that Silicon Valley understands, tried and true. But some of the other technologies, whether it's quantum, a lot of stuff related to fundamental, biotechnology, robotics, at least a decade ago, although it's gotten a lot better given some of the breakthroughs around reinforcement learning, fusion, space. A lot of that doesn't necessarily present the same kind of scaling laws. And so my concern and why I've avoided a lot of those investments is just because some of the mistakes that were made the first go around in the clean tech cycle. I think venture is very good for software, for high margin businesses, for things that require, 100 million, to get a product, prove out the technology. Once you start to be like a billion to multiple billions just to show that your technology or product's even working, it starts to be very challenging in my mind that this is a venture-like opportunity. And so generally have geared my future investing after clean tech towards software and or systems at high margins and true scalability.
I feel like I wonder, so like what kind of unit economics are you leaning towards too? Like, and then I'm pretty sure you invest in like the robotics companies. Are you primarily focused on like the robotics software side of things versus like just literally like, I guess like you mentioned about like you invest in a self-driving car, not self-driving, but I guess like a Tesla competitor, and then it went like nowhere. But obviously you have a lot of great investment. But like I wonder, so like what were the lessons there? Like, and like how do you think about like, I guess hardware as a whole category? Because like nowadays I feel like the industrialization AI stuff are like super popular these days. Like I feel like since I guess like NEA is like very open to like various different industry, how do you write your own thesis? Like what are stuff that you're like completely avoiding or versus like something that you're super excited about? And then what's a unit economics should be looking like if you're investing in a hardware company? And obviously you mentioned about like venture is all about like the high margin software stuff. Do you see, I guess like the hardware stuff making a comeback, or like you feel like this is like definitely a no because the unit economics will never work out?
Yeah, so there's a few questions to unpack there. First is kind of the autonomy question, and then there's a question about hardware and whether it's making a comeback. So first around the autonomy question. So just to separate two things, we did invest in Fisker Automotive, which had nothing to do with autonomy. That was a Tesla competitor at the time. Back to people, it just turned out to be the wrong team, the wrong approach to building an electric vehicle. The reason Tesla works, I believe, is because Elon Musk was an outsider. He applied a very different lens to electric vehicles. He also applied a very Silicon Valley-esque lens in terms of innovate, think about the supply chain, think about the end product, build an incredible product, make it very software-oriented, make it feel like software. That's why that worked. And so that's kind of back to the team, figuring out the best team for the actual company, why it's going to be successful. Now, moving over to autonomy, I think, the opportunity in autonomy and really around self-driving cars, the way we've thought about it historically is to invest in problems which don't have exponential corner cases. So if you look at our portfolio today, and this covers autonomy and robotics, we have really focused more on companies that are focused on constrained environments. So construction yards, distribution yards, factories. And the reason is because you don't have to worry about somebody stepping out in the middle of the road, a dog, something you've never seen before. And so you just have a lot more control on that underlying environment. And so the view, at least my view in investing in autonomy, was focused on constrained environments because that would be less capital intense, that would be faster to get a product to market, that would present for some of these scaling laws that we look for around the economics. And then the other thing we look for when it comes to economics, especially in robotics and autonomy, is what is the ROI to the end customer? One of the reasons I really like industrial robotics is it's basically a math calculation at the end of the day. What does it cost the customer? What is their ROI in terms of how fast that cost pays back? What's the kind of cash flow, the IRR that asset's going to generate? And so a lot of robotics that we've invested in, that's one of the reasons we get excited, is when you look at it on paper relative to what they think they can sell to the customer, what it costs them, what it costs the customer. You generate, 60, 70%, 80% type margins on these autonomous solutions. And the paybacks to the customer are, 1 to 2 years, which is really unheard of in a lot of the industrial space. I mean, they pay back an asset in 3, 4, 5 years. It's an interesting investment. And so when you're going to an industrial customer and selling them a robotics or autonomy solution that pays back within a year, it becomes a no-brainer. And so that's like back to one of the key things that we look for in terms of the margins. And that also plays to the capital intensity, because if you have high margins, that's going to bring down the capital intensity. Because once you start selling these solutions, if you have high margin, that can support what is typically a more intense or larger R&D and engineering team that you need. The trade-off with the autonomy and robotics or software is you need a lot more heavyweight talent. So you really need to have a margin structure that supports that. If the product you're selling requires a lot of services or is very low margin, then it really drives a lot of the capital intensity. So I think I covered two, but there may have been a third question in there.
I think like I have like 5 other questions. You're talking. Okay. I hope, please drink water. But anyway, so
I may have to take a water break here real quick, actually, if you don't mind.
Okay, go for it. Yeah.
All right, you're asking too many questions to get me fired up here. So.
Oh no, I'm so sorry.
Through the camera.
Please stay alive. Okay, so I have a question. Okay, so how, like, since like you invest in like a lot later stage than a lot of other people, first of all, like when the company that actually got to your stage, that they already have some sort of like AIR benchmark and everything else, or like at least like accomplish some sort of like product market fit. And I wonder, like, is there any a common pattern of like where this like those entrepreneurs actually come from? But as you mentioned, like, the company that kind of like failed, it was like because of their kind of, I guess, the opposite of Elon Musk, which is like an outsider approach. But on the other hand, like I feel like in Silicon Valley, a lot of investors are like very pro the second time, I guess, like a core employee from like a tier 1 company, let's say like a Tesla or something, like people do a spin-off, or SpaceX engineer starting something new. Like I wonder, like, is there like a common pattern of like where these founders actually come from that actually make to like the stage that you would personally invest in?
Yeah, I think it's different for every industry. One of the areas I invest, cybersecurity, it's pretty common that cybersecurity founders come from the industry. So that's something that I look for in a lot of the cyber investments. It's hard to start a cybersecurity investment without having a background in cyber, just because of all the idiosyncrasies, having built and sold cyber products, having been a security analyst, a CISO yourself. It's like just a very particular industry to understand the ins and outs. For a lot of the other deep technology or infrastructure investments, something else I noticed is a lot of those founders come from some of the cutting edge research labs. Stanford, Cal. I mean, Cal's produced an amazing amount of huge companies. We've been fortunate to back a lot of them, whether it's Databricks, whether it's Anyscale. Perplexity is another one that's in our portfolio. Just founders coming from the cutting edge research labs. They take their research and they bring that to production. And it really is some of the best research in the world. If they figure out how to productize it, that ends up creating a really large, huge, successful company and opportunity. So in the world of infrastructure, especially in AI, a lot of the founders we backed, they're the leading researchers in the field. Together is a good example there. I backed Together at an early stage at the Series A, but what really drove that decision, it was the world leading cutting edge researchers out of Stanford that had done flash attention, that had really understood networking of distributed systems, doing training on distributed systems. And so a lot of the deep tech, or at least infrastructure plays, it's heavily who's the cutting edge researchers. That's why they're the best researchers in the field. And if you look at my portfolio, there are some multiple time serial entrepreneurs in there. I do think there is an edge for a lot of serial entrepreneurs because they're just less likely to make some of the mistakes founders make the first time, whether it's hiring, which is potentially giving people, too senior titles way in front, or trying to do too many things at once, or not raising enough money or raising too much money. I found second or third time founders, they just don't get bogged down in some of the repeated operational risk that you see with a startup. And they just going to focus on the innovation and what's going to make their startup different, which is really the technology, the product. And then they also have a much easier time hiring because they've kind of hired before, they've seen what's worked, they've seen where the challenges are. I found the second time founders just have a much easier time hiring as well. So yeah, within the firm, we have founders coming from all different walks of life, but in terms of the framework, it kind of depends on what it is that I'm investing in relative to what I look for. And that goes back to VCs about the type of founder, the psychology of the founder, and what I think is going to be super important for the founding team to go build a massive company.
I have so I guess I personally also love the founders that are coming out of a lab or having some sort of technical edge. But however, I feel I guess what does your diligence process kind of look like to vet if they're the tier 1 person in their unique little industry? And obviously if they got into Cal or Stanford as a PhD, they're definitely already gotten filtered out by a lot of other stuff. But the problem is I think the biggest challenge for this type of founder is there's two things. One thing is it's super hyper valuated. So all their stuff are it's already watched by a top VC like yourself and then other top firms, and then so their valuation is typically crazy. And then on the other hand, there is the go-to-market uncertainty, like because they're like very great at recruiting technical talent. So like everybody is like, building stuff, but who is selling stuff? Like 95% of people do not know how to sell. And like how do you kind of like de-risk yourself when you're seeing some like amazing technical talent building something technically great. But I guess like what does the diligence process look like for you to like actually prove that, like I guess like to the partnership that like this is worth the investment?
Yeah, well, I think it's different for early versus late stage, but take an early stage example. The first thing is really validating the quality of the technology and the researchers by talking to other researchers in the field. So not only talking to maybe the founder of the lab that those researchers might be coming out of, talking to researchers at other labs, right? You typically, if you talk to peers within the industry, that gives you a sense of the level, how respected those researchers are within the industry.
Wait, I have a question. So like whenever I feel like as a small angel investor, whenever I talk to these people, they're like, oh yeah, like this guy is under blah blah blah's lab. And then like I have no idea if blah 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 is like which professor is actually the top. Obviously you chat with 5 people, you kind of know, but the problem is like I don't think the information of like, oh yeah, blah blah blah's working under blah 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 is like the best benchmark for me to think this is the best founders, right? So how do you kind of like, I guess what kind of question would you ask to progress with the research?
So there's that. So the first question is, if you spend enough time in the industry, kind of over the past decade, you start to kind of pick up where some of the best labs are. The Rise Lab, AMP Lab, as it was known, out of Berkeley, produces some amazing founders. The second question is really spending a ton of time with the founders, asking how they think. Right? There's nobody else who you can ask about that. At the end of the day, it's talking to the founders, understanding how they think, what are their plans relative to the capital they want to use? Why do they want to use something? How do they think about the product? How do they think about product iteration, the roadmap? What's their personality, right? What are their values? Like a lot of the early stage investments, whether it's seed or Series A, I spend about probably arguably more time just getting to know the founders as a person and their motivators and how they think and what drives them more than the technology of the company itself, because so much of their early stage value is in the founders. And so that kind of comes down to the experience and the repetition of talking to enough founders, seeing success, seeing what have made founders successful, and then trying to do some pattern matching. You obviously want to work with people who are super high integrity, people who are super driven. You want to work with founders that know how to tell a story, or at least have the foundations of what can become a really great story, because storytelling and the narrative is super important for raising capital, finding customers, getting your customers to believe in you, for hiring. So that narrative portion is super important. So there's a realm of things I'm looking for within the search founder when you ask those questions to get their personality type. The technical stuff, I'm not that technical. And so a lot of what the technical side, that I kind of triangulate by talking to other people in the industry, other really deep technical folks I know, could be current NEA partners, could be founders I back that are technical. Hey, so-and-so, meet this super technical founder who's working on a space that's adjacent to you. Spend an hour with them. What do you think? What do you think about their architecture? What do you think about their technology, the roadmap? And so that is really how I go deep on the technology side. But the assessment of the person, their motivations, what makes them tick, why are they going to be driven to build a multi-billion, generational company that changes the world? That's just all on, honestly, me and the pattern matching and judgment that I've been fortunate to be mentored in over a decade to really assess. And look, I also ask them to talk to my partners too. And I love the feedback from my other partners too, because that's another data point I get. Does this founder come off as charismatic? They come off as they're embellishing what they say they're going to do. Do they inspire confidence? Do they inspire you? And so that's the joy and the benefit of being in a partnership, is I also get a whole bunch of other qualitative data points on founders beyond just what their technical capacity is.
Okay, amazing. One audience, Crispin asked, like, curious Aaron's opinion on multiple founders that have had a failures on the book Life Happens. So I guess like basically it's like if a founder, I guess, like raised like money and then like build like a company that didn't really succeed, or like what will happen? I guess that's the question, Crispin.
Sure. Yeah. Well, yeah. No, I think this is the most important part of venture capital. This is also what makes Silicon Valley tick. Most companies do not succeed, right? But the few that do change the world and create everlasting value, make our lives better. And so when you find something, or when you start to get to a point of a company where you think that they're not going to be able to raise the next round, they're going to run out of money before they can actually get to profitability, you have to have the hard conversation with the CEO where you have to say, look, do we think this company is going to be generational? Do we think we're going to be able to make it to the next milestone? Do we have enough cash to make it to the next milestone? What are the proof points? What are the proof points you're looking for? The other challenge that you have with this industry is life's too short, right? We want to make sure we're all working on things that are going to actually change the world. And that's the other question you got to ask the founder is this going as you expected? Do you truly believe that another 6 months, another next year is really going to turn the needle? And most of the time you have this conversation, the founder opens up and says, you know what, you're right. This is more challenging than I thought it was. I don't have as much confidence as I initially thought, or we haven't made as much progress as I hoped. And when you do this, when you have this conversation early on, it's really important because you need enough runway to figure out what to do with the business. At the end of the day, when we're investing in companies, we have a fiduciary duty to all shareholders, founder, investors, debt holders, to maximize the value of that company. And so when you get to a place when you think that the company and the board and the founder no longer believes that this is going to be a generational huge exit, you start to think about, okay, how do I maximize the value? And that typically is looking at, how do I find a strategic acquirer for the business, or how do I potentially get the business to profitability? That could be through a combination of some headcount reduction, could be a combination of maybe some headcount reduction with a little bit more capital from current investors in order to get to profitability. Maybe it's a bridge to give the company runway to go exit. But what's really important is to have that collaborative effort, working with the founder and the rest of the board to figure out what the path is to the local maxima. And if you do it early enough, then you actually get to an exit. If you wait too long, all your options start to be exhausted. And when you have very little money left and a very high burn rate, it's hard to convince existing investors or new investors to put money in when you haven't met the milestones you historically have. And so these are tough conversations. This is honestly, I think, the hardest part about my job is when you actually have to have that conversation with the founder, because their hopes and dreams and efforts and many years have been really dedicated to something, to go to them and say, look, I don't see this going anywhere. That's a really challenging problem, really challenging conversation. But if you're honest and open and transparent and empathetic, you eventually get everyone to alignment where it's yeah, we really have to figure out how to make the best of what we have. And typically when you do it early enough, you can find an exit for a company. And then once you have that exit, what often happens? You treated the founder well, they had a good experience with you, even in a tough time. They go out and they found another company. And the best barometer for if I'm succeeding as an investor, if I'm treating my founders well, is when they invest, when they start a new company, do they call me first? No matter, even if it's a moderate success, even if it's a complete failure, if they call me, that tells me I'm doing my job and I was supporting my founders even in the toughest time.
Love that. I feel like in Silicon Valley, you only hear about this success story big time, but there's so many companies that are I feel like most company I've seen, they don't really fail. The company is not dead, but it's not growing as the venture growth trajectory basically. So I feel it's a really difficult place for founders because everyone obviously wanted to be a mega success, a
totally, yeah. There's, part of Silicon Valley is also the projection of success, right? This idea of fake it till you make it. And there's just a lot of founders out there that continue to, beat their chest, talk about how successful their company is, how much money they've raised, the valuation of the company. But when you get into the weeds, the margins don't work, the economics don't work. There's fundamental existential risk to the question, to the company. And so I think it would be better for people to have more open, honest conversation, founders and VCs, to really think from first principles and figure out did we set out to have we achieved what we set out to do? Are we behind a plan? Are we ahead of plan? How much more time do we think we need to show the viability, to generate the milestones? More of that, I think, would do everybody good, because I think oftentimes people end up running out of money or running the company into the ground
Mm-hmm.
in sole pursuit of this huge success, which may never happen. And if everyone looks around the table early enough and has an honest conversation, that actually gives you time to make something of the company and maybe return capital, maybe make a nice return for the founders, investors, rather than running out of money. And then everyone also has a great experience when you get an exit, no matter how big or small. People feel like, wow, this company, if it's too small, if you didn't return capital, at least the technology can live and prosper within a acquirer who can then go actually take that technology and change the world. Or if it's like a decent exit, the founder maybe has a little bit of money to now take an even bigger risk. And so I think that we would be better suited as VCs as well as founders to ask ourselves those hard questions sooner, rather than feeling like I have money in the balance sheet, I just continue to burn it in pursuit of this grand vision that I set out to go accomplish.
For sure. Okay, so let's dive into the trends. So the first trend will be, let's say, like, what are some, I guess, like, what is like the last 3 companies that you're seeing in the AI space? And what is like the general trend that you feel like they have in common?
So the last company that I invested in or saw?
Either the last company you have invested in the AI space, or let's say the last 3 companies that you've chatted with that are building an AI. What are some trends that you're seeing these days?
Yeah, so right now the biggest trend I'm seeing in AI is there's just a ton of application level founders. The past 3, 4, or 5 years, it was really all about infrastructure, picks and shovels. In order to build and deploy applications, we had to go invest in infrastructure to enable this application to be built. The infrastructure is there. Now we all have the founders that are building applications, applying it to manufacturing, construction, healthcare. There's just a lot of workflow agents for various industries, a lot of voice agents I'm seeing that are piggybacking on a lot of the infrastructure that NVIDIA, together, Databricks, companies have all built, unlocking the ability to now deploy this AI in production. So vertical infrastructure, vertical applications is a pretty key trend. The other thing I'm seeing a lot within AI, increasing a lot of founders as it relates to cybersecurity. Cybersecurity is really going to be changed by AI. It's really going to shift the asymmetry. Cybersecurity has always been asymmetric. Like, the bad guys have always had a lot more power than the good guys, because all you need is one bad day as a good guy and you get hosed. Now AI is going to automate the offensive side of cybersecurity 10x, 100x. Now we need to take AI and bring it over to the defense side so the defenders can keep up with the bad guys on the AI side. And so I think in the past just couple months, I've just seen multitude of founders that are taking AI and applying it to various different cybersecurity workflows, categories, in hopes of getting out ahead of this really scary wave of offensive AI that we all know is coming.
Okay, so speaking of cybersecurity, so you have invested in a few cybersecurity companies like ForAllSecure and Tigera. Like, so why don't we talk about, like, what is your thesis in this space, and then what are things that you feel like should be building? And maybe, like, for the company that you have invested in, why don't we start with, like, how do you meet the founder to the evaluation process?
Yeah, so look, for cyber, we'll exclude AI right now. But my biggest thesis around cyber is that the critical surface area that remains to be protected is really all about identity. If you look at the history of cyber, we have gone from we've gone from laptops, mobile devices, think physical devices, to applications, to data. And now the last thing that really needs to be secured is identity. And historically, a lot of those other pieces of cybersecurity were already disrupted. You have a new endpoint company in terms of securing laptops in CrowdStrike. You've got multi-billion-dollar network companies in Zscaler and Cloudflare. But if you look at identity, besides Okta, which really solved for the authentication, the world of authorization, which is around who can access what, that is still primarily ruled by companies like SailPoint, which actually just went public, as well as CyberArk. Those companies aren't built for the world of the cloud. They're also not built for the world of agents. If we now are going to have thousands of agents running around accessing systems, I really need to understand who can access what and what can those agents do. And I need to be able to approve that in real time so I don't prevent the agent from actually doing its job. And so thinking in a modern way about identity and access reviews and authorization policy, that was my number one thesis in cyber. It's what I've been looking for multiple years. I'm actually leading investment in that area. It hasn't been announced, But I was very glad to have finally been able to invest in this company because it's a founder that I met actually 2 years ago. This is actually a founder who was an early employee in an existing NEA company. And it's a thesis where a couple of years ago, I think the founder had the right product, the right vision. It just wasn't the right time in terms of market traction, validation. The space was fairly new. There was a lot of different other companies pursuing this. But 2 years later, the founders come back, and I've just seen them execute, right? Kind of going back to investing in founders that have a really steep slope. Just the progress the company's made, the vision that he said he was going to go build 2 years later, like they've delivered on it. The customer traction was super early before. Now it's amazing Fortune 500 customers. Just that trajectory, as well as the product vision and how much they built, the complexity of the product while also having a very simple interface. These things all lined up for me and led me to doing the investment. But it all goes back to that founder, having met him a few years ago because it was very thesis driven. I wanted to meet all the founders in this space. I got connected to this founder because he was actually a serial founder. He came to NEA to pitch his previous startup. We didn't invest in that startup. It was acquired, super hungry, mission-driven founder. He wanted to do it again. He came back to us because of our success in investing in cybersecurity infrastructure companies. So as a founder, I've just gotten to know over many years, aligns with the thesis. It's a huge market. I think it's the best technology. They now have distribution. They hired a really amazing go-to-market CRO or COO. And so the distribution angle is checked. So this is just one of those investments where just everything lined up, which is what led to me to getting conviction to do the investment.
I have a question on this. So one day, I have a friend who started a company. They're doing amazing in ARR and everything else. But the founder asked me if they already raised pre-seed and then they were supposed to raise seed. And then the founder asked me if they should just skip seed to raise Series A because they hit the Series A benchmark. And I don't know what my answer should be because I don't know if you should just raise at a higher valuation because of the great benchmark. I guess how do you answer when founder asks you if they should just skip a round?
Yeah. I tend to advise raise as much money as you need, plus a little bit more in case things go wrong to get to the next milestone or value creation. And so if they're pre-seed and they already have Series A metrics, they should absolutely raise at Series A metrics. They should raise a Series A size round because they've proven product market fit, like they've de-risked it. And so I think it's in their interest to raise a larger amount with the Series A because that also comes back to dilution, right? If you raise only a little bit and then 6 months, a year later, you have to raise more, you're probably over diluting yourself. And so I typically advise founders, look at what you've de-risked. There's certain kind of frameworks people look for at Series A, look for at Series B, growth round. If you think you have really gotten product market fit, raise a Series A. If you think you're starting to see that scalability, you're starting to see go-to-market working, you're starting to have an understanding of the unit economics, raise Series B. If everything seems to be working, it's up to the right. It's really just about keep hiring more sales folks, maybe expanding other products, raise a Series C. And raise as much money as the market will tolerate, but within reason. The mistakes I often see founders making is if you raise too much money, you run into this problem where I believe that necessity is the mother of invention, right? So this idea of raising 200 million, 300 million, you end up having too many options. If you raise too much, you try to do everything. What makes startups work is by having constraints. Pressure builds diamonds, not to throw out too many here. But if you raise too much, you tend to do too much. You don't have to make the hard choices, which is really what startups are all about. Startups are all about efficiency and hard choices. If you have infinite money, you're effectively a big company. This is why big companies don't innovate. They can throw billions of dollars at the problem. They can do it on no timeline. And that's why a lot of innovation doesn't happen on large companies. But when you have a founder or a founding team, which mainly has 10 million, 20 million, 30 million, it's in their interest to actually not raise too much. Because you might, as a founder, you might say, well, if I raise more money, now I'm going to have a longer timeline, I'm going to have more runway, there's less likelihood to fail. But for what I've seen, companies who raise too much money actually have an increased chance of failing because there's no urgency. They try to do too much. They don't think critically enough about the problem. And so you do want to raise enough money to make sure you have enough runway, typically at least 2 years, 2 to 3 years when you're going out to market, because you need to have enough milestones that you prove when you go out to raise the next round of capital. But if you raise a lot more money than that, you may be running into trouble because now you just have too much capital. And that historically, and from what I've seen, doesn't end up producing a successful company because they don't have to make the hard choices.
So would you suggest a person just raise like a similar, like it's still called a seed round, but it's like a Series A kind of valuation, or like should they just straight up jump into a Series A, or like to have like the norm?
If this founder is seeing product market fit, could be sometimes there's number of customers up and to the right, millions of dollars in ARR. We invest in Series A companies pre-commercialization. A lot of open source companies, we're just looking at the developer traction, the open source metrics, the contributors, things that point to product market fit. Yeah, absolutely. Raise a Series A, whether you call it a seed or Series A, VCs are very good at seeing through that. I mean, I see companies that are raising like a 200, 300 million seed round, right? There's a company I saw recently, they raised a 350 million Series A round, right? VCs look at it and they're like, okay, what's your product market fit? What's your revenue? Like, we're very good at like distinguishing whether it's a seed or Series A. So I wouldn't worry about what you call it. Just think about it as post product market fit round. If that is your first round after product market fit, raise 15, 20, 25, 30. If it's really, really good, if it's really up and to the right, you can probably raise a bit more than that. But yeah, I would absolutely encourage your friend to go out and raise that Series A if they've got conviction that they're seeing product market fit.
Okay, another question, since we were talking about vertical AI. So in the space, let's say if the company already have like a mega competitor that raised like a ton of money, everyone heard of their name, and like this other company, like let's say this founder started, they're getting some great like traction in terms of like they have paid clients. However, maybe the person have some sort of like unique advantage. Let's say they run a community in the, I don't know, not DevTools, but like a space. So just like a particular domain, let's call it like construction or whatever. Like I don't want to actually stay in a space, but so like actually, so let's say they were like in like a niche space, and then they dominant because of like, let's say the founder is like a community builder, they have like a lot of client relationship, and then they can easily just deploy into the community or like sell within their domain. But on the other hand, there's like a mega competitor that raised from like tier 1 capital a lot of money, and like everyone kind of like, not everyone, but like if you live in Silicon Valley, you've heard of them, like that kind of stuff. Like how do you advise a founder, like what are they supposed to do? Because obviously the founder think, our product's better because we're actually making money, and then this other competitor, they raise a lot of money but they don't make money. Yeah, I guess like what would be your diligence process to be like, okay, is this making sense for me and NEA to like invest?
So we like competition. Competition is super important because if you're the only one in the market, you start to wonder, like, is there really a pot of rainbow, a pot of gold at the end of the rainbow? And so we like competition. For us, it's, competition shows a market, especially in the cybersecurity industry, where our goal is to back and partner with the right founder that's going to build the winner of that space. A lot of software is not winner take all, it's winner take most. But most of these markets, like, you want to be in the number one because the number two, unless the market's big enough, doesn't create a venture-like outcome. And so we are going to look at the competition. We're going to look at their product. We're going to look at their go-to-market. We're going to look at the team. And look, if this product really is 10x better, if it really is a much better product, if the economics of the company relative to the alternative, if the other company's giving away their product for free, eventually that will catch up. You can only give away your product for free. You can only win through inferior economics for so long. Ultimately, what I would encourage this founder to do is to really focus on the competition, why the product's better, and really also focus on the efficiency. Long term, they can raise less money, but if they spend money twice as efficiently, 3 times as efficiently, you don't actually need as much money as their founder, as the competition. And in the long run, capital efficiency is a fundamental tenet of value. More capital efficient companies, if you just look at the public markets, companies that are growing really well, but also very profitable, trade at much higher multiples. And so in the long run, if you think about first principles, in the long run, efficient companies will be more valuable companies. And so for this founder, I would really encourage them to focus on that efficiency, focus on the product, why they win, craft the narrative around this efficiency. Hey, we have a better product. And look, we've gotten farther than this other company with far less capital. What happens if you give us 20 million? Like, we can do 10 times as much with this capital as this other company. We will have caught up with this company in 1 year, having raised 1/3 the amount of money. It's really those stories that tend to catch investors' eyes, and then really focusing in on why the product's better. Customer reviews, super important. So the way we do a lot of the due diligence on the competitor side is we talk to customers. Have you seen this competitor's product? What do you think of this competitor's product? We introduce the company to a lot of customers in our network. They'll talk to us about, here's how this other product compares to this one. And so having this founder get really amazing case studies, ideally folks who have evaluated the competitor's products, which can speak to why their product is best in class. That's also another key that investors will look for, which will give us the conviction to maybe investing against the number one player in a space, because we believe that this founder, product, team, initial customer validation is enough to catch up and surpass somebody else who may have an early lead only because they raised more money and spent a lot more money faster.
What would you ask the expert though? Let's say the founder is building in like, I don't know, constructor AI or something, and then like what do you ask your expert who is, I don't know, the president of CBRE or like something like
yeah, goes back to ROI. So what is the cost? How fast does it pay back? Ease of use. How easy is it for you to deploy this technology? The timeline to actually deliver the ROI. And then the founders, what was this founder like to work with? Were they trustworthy? Were they high integrity? Did they hit the milestones they set out? Do you really view them as a long-term partner? It's not a transaction, it's a long-term partner. Because so many of these early stage customers are really partners. I need to provide a lot of feedback with your product early on. I also need to be super forgiving. And so do you as a customer see that kind of bi-directional relationship with the founding team where you're being treated as more than just a one-off? Like they're giving you fast features, they return your calls, like that. Response time is also super important when we're talking to an end customer, due diligence in a company.
What do you mean by response time? Like how fast does a design partner react to that? Or?
Exactly. How fast does the founder get back to you? When a customer says, we ran into a problem, the product's not working, or really need a feature. What's really amazing, I mean, the investment I spoke to right now doing the cybersecurity investment, a lot of the customers we talked to, so like, yeah, we need a feature. The founder had it in like a week or two, like just like they focused, they cranked it out in a week. And so that ability to reorient resources and deliver what customers want and delight them, that's something that's super important when we're talking to customers of potential investments.
Do we have like a 1 minute fire round time or no?
Yeah, sure.
Okay.
I don't lose my voice.
Oh, okay. Please don't die.
My voice holds out.
Drink water. Okay. What's your favorite book?
Oh man, the problem with my favorite books is I've just read. So it's gotta be science fiction. It's gonna be the last thing that I read. Okay, so classic science fiction. Probably gonna come back to anything by Neil Stephenson. Probably Snow Crash would be most definitive science fiction novel for me because it kind of elaborated on the internet, what it could be, virtual reality. Really kind of got me entrenched in this idea of Silicon Valley being a driving force. Virtual reality is kind of something I haven't made any virtual reality investments, but kind of this world of the metaverse. Yeah, time I think it's got to be Snow Crash is probably original kind of sci-fi that's I think inspires me the most.
Were you a Web3 person or no?
Web3?
Yeah, were you a Web3 person?
No, I didn't go down the crypto rabbit hole. A few of my partners did. For me, there was too much opportunity in everything non-crypto.
Who made the biggest impact in your career?
It's got to go back to biggest impact in my career. It's really Scott Sandell and Ravi and the partners at NEA who are GPs, which took a risk on me when I was an analyst at Catalyst Partners. And they decided to hire me as an associate, and they continued to invest and mentor me and help grow me within the firm. I've been very fortunate to be at NEA for 13 years, primarily because of the generations of GPs that came before me and were willing to give me a rope and also coach me on what it takes to become a great investor.
Why? What is like one quality that you make them want to coach you?
Sorry, one quality that
you are special about that like make other people want to coach you.
one founder that one
No.
quality.
Okay. So, like these like big deals investors, they want to coach you. Why? Like, I guess like what were the initial quality that help you get stand out, basically?
Yeah, I think a few things. One is just really deep understanding of their business and being a sounding board, having empathy for them in terms of the challenges they're facing, where the industry is going to go. Also being a believer, having a shared vision and what it is that they're going to be building. The second thing is just being high integrity, very generous with my time, being very easy to work with, being very transparent is something also having a ton of hustle, just having an amazing network that I'm able to tap into. I've helped many companies hire CFOs, executives. I've made customer introductions to my companies that have led to $1 million deals, just actually having case studies that have shown value. I'm not just an investor that's going to invest and then say, call me, every quarter and tell me about all the progress. I'm going to roll up my sleeves and really help. And so I think this reputation I built of being a true, company builder. I was never an operator or a founder myself, but I've still built an amazing network. I still have the hustle. I still have a really informed thesis and prepared mind when it comes to backing founders and being a sounding board and co-conspirator and helping them go out and execute their vision. Those have been why founders typically choose me.
Who would you invite to a dinner party?
Who would I invite to a dinner party? I think probably Albert Einstein. I mean, the world's smartest man. I would just love to get his view on AI, on humanity, where the world's going. He's one of the world's smartest scientists, but also had a very much understanding that at the end of the day, we're all human. And so his view on the state of humanity, where AI is going, are we going to choose AGI? I think that would just be an incredible conversation.
Amazing. Where can we find you outside of work?
Where can you find me?
Outside of work.
Outside of work, really into cycling. Again, it's probably the cliche VC thing, but over the pandemic, I got into road biking, also triathlons. Haven't been swimming as much, but really love cycling, being outdoors. Fortunate to live in the trees, so spend a lot of time riding my bike or hiking and being out in the wilderness.
Amazing. Well, Aaron, thank you so much for coming on the show today. It was a fun conversation.
Thanks, Race, for all the great questions. Thanks for keeping me on my toes and making me talk enough to lose my voice. So looking forward to the next one.
Thank you. Okay, let me quickly end stream. Okay.